Rule 1 is the closed trade equity curve algorithm for the money management algorithm. So what it does is it takes a look at the moving average dual period of the closed trade. So there's two different types of equity curves that we look at in the money management algorithms. Different rules look at different equity curves and have different sets of rules, but the open equity looks at a bar by bar basis, and the closed equity looks at the equity at the close of the trade, at the end of the trade. And so this rule particularly just looks at the closed trade equity curve and not the open equity. So important distinction to make. Rule 1, closed trade equity curve. And what it does is it takes a look at the fast moving average, and if the fast moving average is above the slow moving average, then we trade the original strategy. If it's below it, then we don't trade the original strategy. You can modify L1 and L2 within the money management algorithms to customize your setup based on your rules. And so take a look here. The black box represents a trading system. That black equity curve represents the original equity curve of the strategy. And so this can be applied to any strategy, whether you have the code or not, if it's someone else's strategy. And what the red line is the fast moving average. So you have the equity curve here, the black line. The L1 is the fast moving average, while the L2, the green line, represents the slow moving average. So there are 3 periods of time in this example where the strategy does not trade. The money management algorithm does not trade the original strategy. So it's looking at the original strategy, and during this time period right here, the green line, the red line crosses below the green line, so it doesn't trade during this time period. Here it happens again, the red line crosses below the green line, so it doesn't trade during that time period. And then once again here, the red line crosses below the green line. And so you have 3 time periods here, 1, 2, 3, where it doesn't trade. And so while you still are a part of the drawdown, there is no perfect way to avoid any drawdown in trading, but you miss some of these drawdowns. And so that's how it's set up. And this is a theoretical example of how this works. This is the money management algorithm. It's looking at this original strategy, and this original strategy has to continue to plot. So if you program this rule into your original strategy and it turns off the strategy right here, it will no longer continue to plot. And your strategy will be stuck at that point. And so you could program it to turn it back on after a certain time period, but the money management algorithms are the purest form of doing this because it continues to look at the original strategy, while the original strategy just trades based on its original market rules. And so you have a strategy with market rules, and then you have a money management algorithm to manage that strategy with equity curve algorithm rules.